As you can hear, I do have a bit of a speech impediment. I come from South Africa, so I've got a bit of an accent. I do tend to talk a little bit fast sometimes. If I run along too fast, please put up your hand. I'll slow down, and Vicky will translate if you need to. What I'm going to be talking about is the AIA product and really the strength of our product, where we are strong, and a lot about the application of the product. Now, if you remember when you registered, we asked you to submit any questions that you might have. A lot of the questions that came through were, can I please tell you where our points of differentiation are, and also where our main standouts are, where are we better than other companies. It's not really my style, and I don't want to get into the whole trap of comparing ourselves to other companies directly, but I will address your questions, and if there's anything that specifically that you need addressing, just let me know and we'll take it from there. I thought that Vicky was going to say that I'm exceptionally intelligent, but she didn't. She said I'm knowledgeable, but maybe next time you can say I'm intelligent too, so that's all right. Okay, I'm going to be using the whiteboard to explain quite a couple of concepts, and I think the cameras will be focusing on here, so you'll be able to see it up there as well. But I first need to remove my jacket, if you don't mind. Okay. Now, everything that I'm going to say to you from here on is general advice. It is not personal advice, so you can't sue me or AIA or anybody else. I went last week, I had to attend an ASIC work. Is anybody here from ASIC? I had to attend an ASIC workshop. I don't know, I did something wrong in my former life, but I had to sit there for a whole day on compliance. It's quite very interesting, but they were talking about this, and they were saying that this has to stay on at least for 20 seconds so that you can read. Okay. Yeah, can you read it from the back? I'll tell you what it says. All it says is, don't believe a thing I say. Okay, all right. Okay, so what I'm talking about really is, we all know that when you go and see a client, one of your main aims or the main thrust is probably to sell the claim. Because if you're not selling the claim, what are you selling? And we're going to have a lot of talks here later on after me in terms of claims and different events. But what I'm saying in my presentation to a large extent is, what happens to the client after the claim? What do we provide? So let's just have a look and see a couple of them. I'm just going to take it benefit by benefit. So the first thing we talk about is death claim. Now, death claim, death policies, death cover. Life cover is life cover is life cover. If you want to claim from this benefit, all the person has to do is die, unfortunately. But there's no funny things about a life cover claim. So I just want to run through a couple of things. I'm sure you're all aware that when a person dies, all insurance companies will basically offer you a final expenses benefit. Ours, we set at $25,000, which we feel is a nice amount. Why do we do that? How can you actually utilize that? I'm sure that you all know that when a person dies, their bank has to be notified, and the bank account is then frozen. So how does the surviving spouse or the partner get funds to live? Because they have to carry on living. They have their own expenses to meet. You can utilize that money, not just for paying for the funeral, but for actually giving them funds to live on. Especially important if you're writing in the business insurance market. A business insurance market, if you're writing in a partnership, buy-sell agreements, what happens when one of the partner dies? Automatically, that partnership is dissolved, and the bank account is frozen. So how does that partnership carry on paying salaries? How do they pay their day-to-day expenses to keep their business running? Vitally important if you're doing business insurance. Don't forget about that. Now, all companies offer that, but some companies will give you $15,000. There's one other company that goes up to $30,000, I think, but it's there. Use it. Financial planning reimbursement, up to $3,000. So what we're saying is, once the lump sum has been paid to the spouse or the surviving partner or the beneficiary, that person can employ an advisor, and hopefully it's you, to actually give them advice on how to invest that money or how to deal with that lump sum of money. So you would then write them an invoice, and the surviving partner or beneficiary would give us that invoice, and we would then pay that up to $3,000 over and above the death value. All right? It's just interesting to note that when we do receive those, that every single one of them is exactly for $3,000. So use it. It's there. If you don't use it, it goes into my fund. Okay. Needle stick injury. We were pressured, not pressured, but there was a big call to bring out needle stick injury for medical professionals on both the income protection side and on the lump sum side. So on our lump sum side, what we've done is we have introduced needle stick for anybody who falls in the medical profession. And I was going through the list the other day, and I was surprised to find that a veterinary surgeon can get needle stick cover. I don't know, animals with HIV or Hep B, Hep C. So I asked about that. Why do we cover veterinary surgeons for HIV, Hep B, and Hep C? It's not like the canary gets it. And they said to me that perhaps the person who's bringing in the animal has got HIV, Hep B, or Hep C, and they run amok in the veterinary surgery and something happens. Rightio. Be that as it may. Okay, needle stick injury is there. The beauty about our needle stick injury is that it pays up to $1 million once the person is diagnosed as HIV positive, Hep B, Hep C. And it pays out that $1 million, and it does not reduce the cost, does not reduce the life cover at all. And look at the cost. 30 cents a day for $1 million worth of cover. Now, if you're a medical professional, I think you can afford that. 30 cents a day. You're spending 10 times that amount on the cup of coffee every morning. But 30 cents a day for $1 million worth of life cover and $1 million worth of needle stick cover does not reduce the sum insured. You've got to take it. You've got to give it to every single client. Death, accidental death benefit. Now, this is an important one because there's only 2 companies out there that actually give you a standalone accidental death benefit. 2 companies. Now, other companies will give you a booster benefit. So if you die as a result of an accident, then maybe you'll get an extra $50,000 or whatever. But this is a totally standalone benefit. And it also qualifies for multi-plan discounting, which is important because at the end of the session, Mitch at the back, he's going to be doing a session on how you use the quotation system, etc. And he's going to show you ways of using the accidental death benefit to actually reduce your premium. So it doesn't make sense, huh? You're giving them an extra benefit to reduce the premium. But Mitch knows all about that. He's going to talk about it. I like this benefit. Why? Because irrespective of the health of the client, irrespective, we don't ask any medical questions whatsoever. So it doesn't matter if the person's only got 1 lung or half a brain or 3 kidneys, really, really not interested in that. They're guaranteed to get that cover. Guaranteed issue. So your uninsurables. What about homemakers? You know that all insurance companies will limit the amount of cover that we give to housewives and house husbands. All right? But not this. So you can give them that life cover, and you can give them accidental death benefit, no medical questions, an additional $1 million cover. You can also put that inside super. No problem with that. The nice thing about our benefit is that it starts at age 18 and it ceases at age 99 for $1 million worth of cover. The premium is a universal premium. So it does not matter if you are male or non-male, or if you're a smoker or non-smoker, irrespective of your age. We don't care, we don't care, we don't care, we don't care, we don't care. You pay one premium. So an 18-year-old will pay exactly the same premium as a 65-year-old. And that premium will stay level all the way through to age 99. At age 65, like normal retail policies, it does not change to stepped. And that's a point of differentiation. Okay, so every time I touch my right ear, that's a point of differentiation. It's a point of differentiation. We do not change to step premium at age 65. It is level all the way through. You know how much life cover costs at age 65, and you know that's the reason why people actually cancel their life cover. Here's an opportunity for them to actually keep some type of life cover, because the incidence of accidents after age 65 increases. So you want to keep that cover? Yeah. Okay. That's a nice one. Question.
Is there a limit on when you can apply for it?
Yes, there is. Minimum age 18, and I think that is 75. So who's got a PDS at the back there? Mitch? We'll get the answer to you. Okay. Yeah.
At the date of entry, the premium is the same for 50 years old as 30 years old.
Yes. Yeah. So we've smoothed it out. It's one premium. So if you are paying $65 per month over here, as an example, when you get to age 99, you're going to be paying $65 per month for the same amount of cover. $65 when you are 99 is going to be about the cost of a cup of coffee. So as you just look at it this way, if you take inflation into account, the premium on this policy actually gets cheaper the longer you live. Yeah? If inflation is running at 5%, the premium is getting 5% cheaper every single year. Mitch? 60 next birthday. Yes, accidental death is any event, external, violent, that is not initiated by yourself and is not, yeah. We've got the definition in the PDS, accidental death. So basically, what do you want to talk about? A gunshot is an accident. Falling through a plate glass window is an accident. Coming home at 11 o'clock at night and your wife smacks you over the head with a frying pan. It's an accident. Also murder, but also an accident. Yeah. Okay. So when we talk about accidents, we just think of car accidents really, but it's a lot of other things. I need to get back to...
Say you could get somebody injured after the kick or whatever, it pays immediately or after 3 months or 4 months or whatever. After how long that the accident has happened, is the paid the premium. I mean that the benefit.
We need a copy of the death certificate, and we want to see that there's no hanky-panky going on. So if it's a coronial inquest and there's some doubt in a police report, we will probably wait until that happens, but there's no such thing as going back and checking on a person's health, going back to medical records, Medicare records. Yep. Okay, we need to move on a little bit. Terminal illness, you all know terminal illness, fantastic benefit, but not if you get it. But it's a good benefit because it pays out while the client is still alive and allows them to get to finalize their affairs. How many people actually use that? I don't know. I think that it's underused. Full sum insured paid, which just about every single company does, so nothing too much about that. Whoops. Radio. Have I pulled something out yet? Can you hear me? All hear me? All right. TPD. Now, as you can hear with my accent, I've got my next door neighbor. She's hell-bent on actually, she doesn't like the South African accent, and she's hell-bent on actually trying to get me to talk Australian. So whenever I go over to her house for tea, she tries to teach me Australian. So she tells me I've got to pronounce this as TPD. So, TPD, and then I go to her house for tea, and I have some cheese. Right, cheese. Yeah. Okay, TPD. Why is our TPD strong? Why application of that? TPD is fantastic in the sense that I'm going to give you $5 million own occupation. I'm not going to split it by saying 3 million own and the next 2 million under any. I will give you the full 5 million as own occupation definition. Very, very important if you're writing high net worth clients and if you are writing business insurance, because in business insurance, you will start to see those sums insured coming about. Okay. You'll also notice that we extend our own occupation definition, like other companies, to occupations B and C. So occupation C is our qualified tradespeople. And I urge you to actually go on the quotation system and have a look at our premiums on TPD own occupation. There's only one company that starts with a K, so you can work it out, that has got a cheaper premium than we do. Okay. Very cheap, very competitive premiums, own occupation, occupation C. Partial TPD. Now, partial TPD, we are industry leading in that we will pay a partial benefit of up to $750,000. So, and that's, I get a little bit nervous about that because I've watched enough CSI on TV to know that I can get a pen, take out the sight in one eye, and get paid $750,000 and make it look like an accident. But it is the highest in the industry, and we will pay $750,000 on the loss of use of one leg or one arm or the sight in one eye. So that is there, comes standard. Now, the next thing, waiver of premium on our TPD policies, on our policies, is unique, and I want to show you why. Let's give this person life cover. Let's give them life cover of, I don't know, $2 million. Then let's give them some TPD of 500,000. We'll give them some crisis, let's say of 200,000. We'll give them some accidental death benefit, 1 million. We'll give them some child crisis, that's 200,000. And I've got all the buybacks and reinstatements here and everything. And I'll also give them waiver of premium. What else do you want me to give them, Vicky? Anything else here? No? Is that enough? No? Okay. Also, look, this guy's really, really concerned about crisis. So they say, I want another 800,000 crisis, but I want that as a standalone. Yeah? So that's sitting outside, because these are all riders. Right? Okay. The person then becomes TPD. So what do? We pay out the $500,000. Life cover drops down to 1.5 million. Let's assume that they've got their buybacks in place, so the life cover gets bumped back up to 2 million. But then, importantly, the waiver of premium kicks in. That then kicks in because it'll have the same definition as my TPD. And when that kicks in, we say to the client, thank you very much, we're very sorry about your TPD, but from now on, we will pay the premium on that, on that, on that, on that, on the other reinstatements and buybacks, as well as the premium on that. So the client does not pay any premiums at all. Yeah, and that's quite a good deal. I think that's a good deal. It actually makes you want to do something to get the benefit. Okay. This person is TPD. They're not going to be working again. Where are they going to get the money to pay the premium? So we say, don't worry about it. We will pay the premium for you. And that is different in the industry, if you have a look at my slides. Rightio, if you can just go back to my slides again. All happy with that one? Yeah, good stuff. Pays a premium on all of those benefits. It's in the PDS as well. Now, while we're sticking on waiver of premium, let's just have a look at double TPD. Do you all know how double TPD works? Sure? Let's just run through it quickly. Person has got 2 million life cover. They have double TPD of 800,000. Yeah? The person becomes TPD'd. What happens? They become TPD'd at 20 past 10 in the morning. What happens? We pay that out. What happens to the life cover? Does it reduce? No. The TPD is seamless. It stays there, does not reduce and does not get paid back. It stays at $2 million. But this is what happens afterwards, after the claim. That's what's important. What we do is we then say to the client, we're terribly sorry about being TPD, but what we're going to do is we are going to pay, or we're going to waive, the full premium for the full $2 million, which is unique in the industry. And this is the big point of differentiation. Yeah? The other companies will actually say, because the TPD was $800,000, they will only waive the premium on the portion of $800,000 on that life cover. The client would still then have to find the premium out of their own pocket to pay for the $1.2 million difference on the life cover. We just say, it's too hard. Clients TPD, they're not going back to work, so we're going to pay the full premium for the client. And that is unique. Okay, so you can write that one on your left here, because that's a very good benefit in terms of your double TPD. Now, yeah, okay. I'll show you something when we get to crisis. Crisis recovery, prostate cancer. Now, this has been one of our big success stories, so I'm just going to beat the bandwagon here a little bit. Prostate cancer, and we are the only company in Australia that will actually pay the full benefit on diagnosis of prostate cancer. Now, there's a lot of men in this room, and I'm a man. If you're a man, and I guess if you're a female as well, your prostate gland is very, very important to you. And the chances of getting prostate cancer as a male are increasing all the time. Now, we've taken the stance that we will actually pay the full benefit on diagnosis of prostate cancer at T1A level. Okay. Now, T1A level, I'm going to show you, I'm actually going to draw on the board here how big the cancer is at T1A level. Right, can everybody see that? No, because it's microscopic. You can't see it with the naked eye. Right, but that's when we pay it. If it's discovered, diagnosed, we will then pay. Okay, now, my brother's had prostate cancer. He's had his prostate removed, so I am qualified to talk about this from personal experience. So what happened with my brother when he got prostate cancer? He was diagnosed, and they said to him, look, it's going to need to come out, but not now. So go home, diagnosed there, go home, relax, go and take some leave, have a couple of months leave, get better, get well, etc. Because, you know, when you are confronted with that by the doctors saying you've got cancer, it's a big shock to the system. Okay, and you need to sort of get your mind in order again. So they said to him, go home, get healthy, have a rest, etc., and then we'll remove the prostate. He did that, and 3 months later, they removed the prostate. Now, it's not a small operation. It's not like having a tooth taken out. It really is quite a big operation. And there's quite a long recovery period. So my question to you is, if your clients, or you, God forbid, have to have a prostatectomy, when do you want your money? Do you want it there? Or do you want it here? Now you see I've drawn that after the operation because you only get paid the money after you've survived the operation. So when do you want your money? And you're all aware, and I think it was last year, Vicky, that there was an insurance company that didn't pay out a prostate claim. And there was a big hoo-ha about that. You don't want to be involved in that. So from my perspective, remember this is general advice. It's not personal advice. But for me, I want to have my money here. I don't want to have to wait over there. All right? And that's been a big success story for us. Any questions on prostate cancer? Good. We do have Dr. Pramod Nathaniel at the back. He'll be talking. Anybody wants to talk to him about your prostate, you can do so afterwards. He does take consultations there. When we talk about our cancer definitions, there is another company, AXA. AXA and AIA follow basically the same path in terms of reinstatement of the crisis contract. So if I take crisis for $1 million and the person has cancer, what happens? We pay out the $1 million to the client. They then reinstate their crisis contract. And if they get a second cancer, we will pay them a partial benefit of the higher of 10, we'll pay them 10% with a maximum of 50,000. And it doesn't have to be the same cancer, it can be any other cancer. We don't want to get into the debate of, was this cancer, the second cancer, caused by the first cancer, or are they related, or are they not related? If they hadn't have had the first cancer, would they have got the second cancer? We're not interested in that. We say the person has cancer, we pay them out their benefit. Reinstate the contract. At any stage thereafter, they get a second cancer. We will then pay a partial benefit. So AXA, AIA are the only companies that follow that road at the moment. Okay, very important if this is important to you. Rightio, next one. Skin cancer, so we've changed our definition of skin cancer, so you only need to satisfy one of the three criteria. In other words, more than 1.5 millimeters in depth according to Breslow, or greater than Clark level 3, or with ulceration. So one of those three elements, and we will then pay your full benefit. You also get your financial planning reimbursement when you claim from the cancer, the crisis modules. Once again, opportunity for $3,000. And there's the story on the second cancer event. Leukemia as well is, I put an industry-leading question mark because some of the companies, we're the only company that actually has it in our main benefit, but the other companies will have it in their standard contract at the bottom. And what that means is that we will pay the full benefit on diagnosis of leukemia at RICE stage 0. Okay, that's important. So it is a point of differentiation. Other companies will only pay after RICE stage 1 or RICE stage 2, but we will pay the full benefit at RICE stage 0. Now, every morning when I get up in the morning and I make my coffee and have a shower, I then put on I think it's Sky News, yep, and they have a lot of adverts in terms of cancer and a lot of charities. If you watch it early in the morning, you'll see there's a lot of charity adverts, and a lot of them are for leukemia. Leukemia is big. Okay, so it definitely is out there. It is one of those events that do happen, not like some other events that are covered. Heart attack. Now, our heart attack definition is very robust. We will pay a full benefit for a heart attack irrespective of the severity. Now, there's been a lot of hype lately over the last week or so in terms of one of the other companies bringing out a new heart attack definition. Do you all know about it? Yeah? You went to the launch and they spoke to you about it? Okay, Asteron have brought out a new heart attack definition, and there's a lot of hype in the market. So what we are saying, and this will be confirmed by Dr. Pramod after my session, is that AIA, Asteron, irrespective of the degree of severity of the heart attack, we will pay just as Asteron will now pay as well. Okay? This now will include a minor heart attack. Absolutely minor. So we will pay the full benefit. We have had our definition for the last 4 years, since 2008. And Dr. Pramod will actually give you a little bit of history in terms of that. Our definition was miles ahead of the industry for the last 4 years. It is only now recently that it's been recognized as being the best in the industry, as being the most fair. Because when we develop our benefits and when we develop our definitions, we don't develop it to suit the rating houses. We actually develop our benefits and definitions to suit the client, to make it fair for the client. So we've actually waited 4 years for the rating houses to actually agree that our heart attack definition is the best from a client's perspective. Okay? I'm not going to say too much more about heart attack definition, other than it is very robust. It's been in place for 4 years. We've got 4 years' worth of track history that we can rely on to know that our definition will stand the test of time. Rightio, we can go to the next one. Thank you. Complementary family protection, that's our child crisis. So we have $20,000 there. You get free of charge in the market. So every time the person takes out crisis contract, they will get $20,000 per child. So if they've got 10 children, they will get $20,000 per child. All right? That is a point of differentiation in terms of the amount that we pay. $20,000 is the highest. And then waiver of premium on double crisis recovery. I said I'd show you something. Remember what I showed you about double TPD? Showed you how double TPD works. It's exactly the same as double crisis. But Mr. Krug, you can't look at this. You need to look away and block your ears while I tell them this. All right. So basically, this is how it works. Now, you've got to promise me that you don't do what I'm going to show you. Okay? But I need to show you the principle in terms of this, because this leads on to something else. If a person takes out life cover, let's just say of $2 million, in theory, this is in theory. Now, you can't actually do it because the quoting system won't let you. But in theory, you could take $1,000 worth of crisis, double crisis. Something happens to the client, so we pay out $1,000 worth of crisis, but what's the net effect? You can work it out. Okay. But you can't do that now. But I'll show you the power of that. Okay? That's how powerful that benefit is. Sorry? Are you allowed to do that? You can't. The quoting system won't allow you to do it to that level. But what I'm saying is, if you look, we all talk about crisis has got a limit of $2 million. I know of one person who's actually got $2 million worth of crisis. So people don't take levels of $2 million, well, not that I've seen. But people do have levels here, 100,000, 125, 150, we're talking about that. So you would have $100,000 seriously of crisis here, that's quite okay. And then people will have $1 million worth of life cover or 1.5 million. If they do suffer a crisis event, 100,000 gets paid out. But then the full premium on the 1.5 million life cover is paid to age 65. So, and that's what happens. So with the other companies, they would only waive the premium for the 100,000 portion of the life cover. The client would then have to find the other premium for the $1.4 million worth of life cover. You with me? Yeah. But we say, it's too hard. We're going to pay the full premium on the full 1.5 million because we believe that's the right thing to do for the client. Okay. So that's the approach that we've taken. Right. Now, this one, forward underwriting benefit. Now, I've spoken about this. Has anybody ever heard me speak about this before? You're allowed to? Yeah, if you have, I'm sorry, you've got to listen to me again. But when I first presented this in Sydney, I took a bit of a stance, and I stood up and I said, I'm going to show you a benefit that's actually better than Vegemite. And a whole lot of people got quite grumpy with me. And they said, I won't tell you what they actually said, but they got a little bit grumpy. But at the end of my presentation, when I'd shown it to them, they actually turned around and said, you know what, this is better than Vegemite. So I'm going to show you how this benefit works because it is an incredibly important benefit. It is very, very misunderstood. And hopefully at the end of today, you'll be able to take this benefit and apply it in every single selling situation that you've got. So first of all, we go back to our life cover. Let's give the client $2 million life cover. All right? Let's give them some crisis. How much crisis do you want them to have? Okay, let's give them $1 million. 1 million crisis. Okay? Now, this is a rider to the life cover. Let's assume that we've got the buybacks and we've got the reinstatements and all of that stuff. Now, hanging off this life cover benefit is an ancillary benefit. This is like your baby toe. It can't survive on its own. It's got to hang on to something. So the forward underwriting benefit hangs off the life cover. It has got no relation to the life cover whatsoever. It just hangs off it. It's like a picture. You see, there's the nail. You can't hang a picture if you don't have a wall. I can't have the FUB benefit if I don't have the life cover benefit. That's it. Now, this client comes along and says, yes, I would like this forward underwriting benefit. And what this means is a client is going to buy cover now that they can use in the future with no underwriting whatsoever, irrespective of their state of health. I don't care. So we're going to underwrite them today at today's health. So you're fit and healthy today. And unfortunately, what happens is as we get older, as Pramod will tell you, we start to, what did you say? Decompose. All right. So that's what happens. So you need to buy this benefit while you're young and fit and healthy. This client says, yes, I want to have some. Now, you can buy this cover. This person can buy between $100,000 and 10 million's worth of future cover. So in the future, they can buy cover up to $10 million. This client's not going there. He's not that ambitious. The client says, I want to have $5 million. So we say that in the future, this client can buy life cover and TPD and crisis in the future up to the value of $5 million, within industry limits, obviously. Now, point of differentiation number one. Even if this client had no crisis there, they buy forward underwriting benefit. At a later stage, when they're 55, they decide that they need some crisis cover because things start happening. They say, I want to get whatever, how much crisis. We will give it to them without any medical questions whatsoever, even though they had no crisis at the inception of the policy. So having crisis at the inception is not a requirement. You can have straight life cover, and you can buy TPD or crisis later on. Yeah? Good thing, isn't it? Better than Vegemite, remember. Okay. So what happens? This client comes along. Comes over here. Now, I normally tell a little story about this. The guy comes along. He takes his wife to a restaurant, and he says to her, darling, will you marry me? And she turns around surprisingly and says, yes. And he has a heart attack. Gets such a shock, his pump goes into spasm. What do? We pay out the crisis. Yeah? We give the client $1 million. That drops down to $1 million. It's got the buyback. Goes back up to $2 million, yeah? Right. Comes along, he proposed, she accepted, he had his heart attack, he's now healthy. They get married. So marriage is one of the trigger events on the forward underwriting benefit. So when they get married, he gets a 25% option. So we say to him, he can take 25% of $5 million and buy in it either life cover and or TPD and or crisis to the value of 25% of that. So 25% of $5 million is what, Vicky? 1.25 million. Okay. I always like catching the mouth like that. 1.25 million. This client says, that's nice. We say to the client, what do you want? He says, you know what, I like this crisis. It's actually quite handy. Can I have some more, please? We say, yes, with pleasure. How much do you want? He says, I want all of it. We say, okay. So we give him more crisis, 1.25 million, and away we go. Ding, 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 ding. Comes home one day, and his wife says to him, darling, we are 2, about to be 3. I'm pregnant. Because he's such a nervous chap, he gets a bit of a shock, and his pump goes into spasm again. and he has a second heart attack. That's heart attack number 2. Number 1, number 2. So what do? Because he bought the crisis policy under a forward underwriting option, it has no relation to his previous crisis. Because when he took this out, we said to him, we guarantee we will give you this cover irrespective of your state of health. So he has his second heart attack. So what happens? We pay out 1.25 million. No, he's now pays a premium at his new age, at his appropriate age, which he's quite happy to do because he's now had 2 of these things and he actually understands the value and the benefit of this little arrangement. All right? So, he comes along, his wife gives birth, which is another option event. So, we say to the client, hey, listen, this is like winning the lotto. You can now get another 25% of your 5 million. 25% of 5 million is what, Vicky? 1.25 million. So the client says, I like this crisis stuff. Can I have some more? We say, with pleasure. How much do you want? And he said, as much as I can get. We say, okay, well, you can have 25% of that, 1.25 million, and away we go. Except that now, this is going to be limited to cancer events and other serious events. He's had his heart attacks. We're not paying for any more heart attacks. Client comes along. He enjoys the beautiful, warm, sunny weather in Sydney, and unfortunately, he gets diagnosed with a melanoma over there, cancer. So we will then pay another 1.25 million, and that's the end of his crisis. So in essence, at the end of the day, what have we paid the client? $3.5 million worth of crisis.
All those benefits, if he gets married with the same wife,
Okay. So the option events that we have are marriage, 25%, divorce, 25%, birth of a child or adoption, 25%, registration of a new mortgage, which will be 50% of the higher of, so the lesser of, 50% of your forward underwriting benefit and the actual mortgage. And then we also cover, most importantly, our 3 main business insurance events. And that's why this benefit was developed, really to look after the business insurance elements, which are buy-sell, key person, and debt protection when you have loan guarantor. So we cover all of those. And that's why it was pegged at 10 million to take care of the business insurance market. Now, I must be honest with you that we don't see too many people taking out forward underwriting benefit of 5 million. People will take out here 1 million or $2 million worth of forward underwriting benefit. It is cheap. It's bargain basement stuff. It really, really is. The forward underwriting benefit costs between 9 and 11% of the cost of the life cover. So you can basically say it's 10% of the cost of the life cover. How cheap is that? To get all of this, so you buy this when you are 18 or whenever it is, you can, and you have to use all of this before age 65. We don't force you to use it, but at age 65, all the options then become null and void. So how good is this? You take it out at 18 when you are immortal, invincible, indestructible. And when you get to your 50s, you can then start exercising if you want to. If you don't use it, you don't lose it. It stays. Yeah? So I can do exactly the same benefits here taking TPD as well. That's why I say that this is better than Vegemite. Yeah? Good benefit. So when you see your clients, you might not want to give them 2 million. Give them $1 million. Do them a favor. It's the best thing that you can do for your clients, taking their future into account. Okay? Any questions on forward underwriting? Because I now need to move on.
Can you take out TPD and crisis?
Yes, yes. So I've got 1.25 million. The client can say, I want 500,000 crisis, 500,000 TPD, and 250,000 life cover. Or they can say, hey, listen, I just want 500,000 TPD. I don't have to take the full 25%. Take what I want. Okay.
Michael,
Yes.
when you mentioned about the buyback on the life cover after the...
Can you point to the other hand and speak into the mic?
Surely. When you mentioned about the buyback of the life cover, you sort of quickly said, oh, we've got the buyback.
Yeah.
Now, is that 12 months?
Yes.
Right.
Yeah.
No.
Yes, on the life cover, yeah.
And then when he had the second event, same scenario, 12 months?
Yeah.
Right.
Yeah. I'm just short circuiting it. So, but it's the same thing. I can have my crisis sitting outside. I would still pay the crisis. The second event is not going to have any impact on that. Rightio. Okay, let's move on. There, the last point. If the options are not exercised in any way, the benefit is not lost or reduced. It is only cancelled, ceases at age 65. Right. Okay, now we go into income protection. There's a couple of points here that I need to talk to you about as being points of differentiation. The first one is the severity benefit. Now, you know that the reason why we only pay 75% of income is because we need to leave an incentive for the clients to claim, for the clients to go back to work. If you had to take away 25% of my salary, I wouldn't be able to survive. So I've got a big incentive to get back to work and earn 100%. Right. But if a client is TPD'd, then they're not going back to work. So where's the incentive to go back to work? They're not going back to work. So why am I still only paying them 75% of income if there's no incentive to go? So what we say is, if the client is TPD'd, and at the moment, I've got it, there's ADL definitions, then we will pay 100% of their income to age 65. So how that works is, if the client is earning $10,000 a month, yes, 75% of that is $7,500. That's what their monthly benefit is. They then become TPD'd. I take that, I multiply it by 0.33 recurring, and that equals to 2,500. 2,500 plus 7,500 is equal to 10,000. That's how I get to my full amount there. Yeah? TPD'd. Yes. All right. No incentive to go back to work. Why am I still penalizing them on 75%? Away you go. So that is also a point of differentiation. That comes free of charge in every single income protection contract. The next benefit I have there is the TPD disability, the lump sum. So the client can elect, if they become TPD'd, to have all of their future payments commuted into a single lump sum payment, which is then paid out tax-free. The cost of that is 5%, and it's a very, 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 very good advantage or option to give to the client, because it is up to the client. It is at the client's discretion as to whether to exercise that or not. It is not our option. So we do not come along and say, are you TPD'd? You have to take the commuted value. We say to the client, you meet the TPD definition, own occupation, this option is available to you. Do you want to take it or not? So it all depends on the disability, the life expectancy after the disability, all of those factors before they can actually make a decision. But the decision, the power rests in the hands of the client. Now, do all of you know ComInsure's TPD disability benefit? I'm sure you do. Ours is modeled exactly on ComInsure's. We did not want to start a benefit war, so we took ComInsure's definition and their structure, and we copied it exactly, except for one difference. With ComInsure's, you are allowed to claim 90% of your premium back from tax. So the ATO have got a ruling, 90% back on the income protection premium, and then the lump sum will be paid out tax-free. Ours is different. With ours, 100% of the income protection premium is tax deductible. The premium for the lump sum disability is not tax deductible, but cost is 5%. Now I've got in my bag over there, I've got a whole lot of calculations on all the different companies, etc. And you'll see that from a tax aspect, it's better actually to claim back 100% of your income protection premium and not the disability premium 5% versus 10% of the premium. It's pretty much 6 of one, half a dozen there, but it's exactly this. It's pretty much the same. But otherwise, our commutation factors, all our exclusions, all our conditions, terms and conditions, exactly the same. Good benefit to have. Partial disablement. Did you know that about partial disablement? Those of you who knew about that, be honest and put your hands up. Pramod, you put your hand up for anything. Yeah. If your client is partially disabled and they submit a partial disablement claim, and that means that they are still working to a lesser extent. If they are earning less than 25% of their PDI, their pre-disablement income, in the first 3 months, in any of the first 3 months, we will still pay their full benefit. Now, that to me is important because in the first 3 months after a disabling event, that is when the client is going to rehab, getting sorted out. Maybe they're still lying in the hospital to a certain extent, or they're visiting the hospital as an outpatient. I don't need them to stress about how much money are they going to survive on, can they survive, what's happening in those first couple of months, because those are the important months. In that event, we will pay 100% of their income. So that's a good news story that you can take to your clients and tell them when you're selling income protection, how the clients are actually being looked after. Yep? Any questions on that? It's very good. Okay. Total disablement. So we have a no-claim bonus. Whoopee, so does everybody else. But ours is done a little bit differently. Whereas we will not reduce the premium, we actually increase the benefit amount. So if the person is earning $10,000 a month and they have not claimed in the first 5 years of their policy, when they do go and claim, we will increase that by 15%. 3 years no claim, increased by 5. 4 years no claim, increased by 10. 5 years no claim, increased by 15%. So the client goes on claim. I will then take that multiplied by 15%, which is what? 1,500, and I will pay them 11,500. Yeah? Now just think that after 5 years, just about every single one of our income protection contracts has got benefit indexation on. So that is increasing by 5% every single year. Yeah? After 5 years, that's gone up by 5%. I can't do the maths, all of it. But whatever that amount is after 5 years, or 6 years, or 7 years, we take that and multiply that by 15%. Not the original amount, but the amount of their benefit at time of claim. How good is that? I know they're going to be, I'm just going to preempt some questions here. Some of the people are going to say, but now I'm paying more than 75% replacement ratio, and in some instances I'll be paying more than 100% of their income. Yes, I will be. That's fine. Okay? That's the way it is. Take it. Okay. That comes free of charge with all of our plus optional contracts. All right. Now, something that we also developed, if you can just go back here, is, it's not on the board here, but it is our Advantage Optional. Advantage Optional is when you take out our standard income protection, because you've got income protection, then you get the plus optional, which gives you all the benefits, or it does absolutely everything. If you take the standard contract, you can then select Advantage Optional. And that means that you will then be given the multi-tier definition. So the client will be assessed against duties, cannot perform the important duties of the occupation, or is working less than 10 hours a week, or is earning less than 25% of PDI. So you get the duties, the time, and the income definition on the Advantage Optional. In addition, the client also gets specified injuries benefit, where we pay so many months benefit if they break their leg or their arm or their head or whatever it might be. So that is the Advantage Optional, and that comes in on the standard contract. A lot of people ask me the question, and I forgot to put on my slides. The question has come through: when are we going to start covering diabetes? Well, we did start. We started in December last year. From the 3rd of December last year, diabetes, severe diabetes, which takes care of type 1 and type 2, get covered in our crisis contract. All right? Okay. I think this is my last slide. I think maximize the TPD. Maximize the TPD. Any of you here write Macquarie? Yes? Oh, sorry. Okay, Macquarie have got this exact benefit called Optimizer. You know the Optimizer benefit? Right. Now, once again, we did not want to get into a benefit war with Macquarie, so we took Macquarie's benefit and we basically replicated, we duplicated their benefit exactly. So basically, for those of you who don't know how this works, it really, really is a fantastic benefit. I'll just take 2 minutes and then I'll be stopping. So if I have my superannuation here, I've got my life cover. Let's say my life cover is 1 million. Yep, 1 million. We then take TPD, any occupation, because you know now we have a couple of restrictions if we put own in there. So I have any TPD, and I put in there $500,000 worth of life cover, of TPD cover, which is a rider to my life cover. I then take out another policy, TPD, own occupation, 500,000 cover. Own occupation. Any occupation, own occupation. 500, 500. But now, the cover of 500,000 between these two policies, policy 1, policy 2, is common. So this client does not have $1 million worth of TPD cover. They've got $1 million life cover, but $500,000 worth of TPD. Now, the premium, we'll just go through. Let's assume that the premium for this $500,000 is $150 per month. Let's just assume. So that premium is, how's that premium made up? 2/3 of the premium, in other words, $100, pays for the any occupation definition. Own occupation gets a 50% loading. 50% of $100 is $50. That's that portion. 100 plus 50 is 150, which is the total premium. Why is this important? Because now the client can, well, that $100 can now be deducted under super. So they still get the tax deduction of the $100 under super. They don't get the deduction of the $50 outside of super. But if the client claims under the own occupation definition, then the full $500,000 is tax-free. So what happens? In order for us to get this right, the ATO said, okay, we'll allow you to do this. We'll allow you to get deduction of the premium and also to swing it outside on one condition. When the client claims, you have to assess the person inside super first. So we will assess the claim. It meets the definition of any occupation as far as we're concerned. We go to super, we say to the trustees, here's the claim, meets the definition. The trustee then will have a look and see, does this claim meet a condition of release? If the answer is yes, it meets a condition of release, then the money is paid out. We pay the money to the trustee. The trustee will then pay out the money to the member. Right? Everything's good. If the trustee says no, we don't think that this is going to meet the condition of release because of the following reasons, 1, 2, 3, 4, we will say, thank you very much. We will actually swing the claim outside and assess it under own occupation, and there we go. And we pay it outside of super, and it gets paid free of tax.
So these $500 would be paid free of tax. What about the $500,000 that
Right. So if the
decision, because the trustee has to make a decision on the $500,000 as well there.
only inside there.
Trustee of the owner, I mean the person, I believe that's the ordinary policy, that would be valid for the trustee as well.
No. The question is, does it? I think if I'm hearing you correctly, Does the trustee have any influence over the payment of this 500,000? No. Trustee's got absolutely nothing to say about the 500,000 outside of superannuation. Yeah.
In that circumstance, if you had a situation like that and the client was, say, 40 years old and the conditions of release didn't allow it to be paid through the super fund because, hey, you didn't meet this condition because your age, we're not going to pay you until you get age 60, would OIA pay that own occupation 500?
Yeah.
If the client is 40, once they turn 60, would they then release that 500,000 there?
No, this is common. Once you pay it out here, that falls away.
Okay, fair
So
enough.
what I've also done is I've included buyback here.
What about if it was a standalone?
Yeah, hold on. I've included
Yeah.
TPD buyback. So if a client claims here or there, doesn't matter where they claim,
Yeah.
buyback will now give them their life cover back.
Okay.
So they can also claim their buyback premium as well. That's a common sum insured. So if the client doesn't meet, or if the client doesn't meet the any occupation definition, we'll engage the trustees, but basically we're going to swing the claim out and pay it under own occupation. Okay, so we're going to find clients saying, yes, I do meet the any occupation definition. Of course I can do any other occupation. Because they don't want to be assessed under here, they want to be assessed under here.
Yeah, true.
So we're going to see a total reversal of what's been happening in the past. But as you need to go back, Vicky and her team know all about this. This can give you surprisingly good tax benefits and tax efficiency, as well as your cash flow. Okay. I'm running low of time, so I'll take the last question.
If the client claim is assessed under the category of any occupation, in this scenario, if the client claim is assessed under the category of any occupation, do we say that he's automatically qualified under the own occupation as well?
Yeah, but the ATO says we'll have to assess it here first.
No, that's okay. But the client is definitely qualified for the own occupation if his claim is successful under the any occupation.
Yes.
That's okay. Thank you.
Yeah. All right. And I think that's the last slide that I have. Hello. Is that the last? I think last slide. Okay, that's my last slide. Thank you very much. And I think there's a tea break now, Pina. Thank you very much. Thank you.